கொடுத்துடாத இப்போ கொடுக்காத.
ஓகே க்ளோஸ் பண்ணிட்டேன்.
போயிட்டு இருக்கோம்டா இப்போ.
Meeting is now live streaming on custom. Meeting is now live streaming on custom.
Yeah, now you can start.
Okay. Good evening, everyone. I'm Janani, a member of FinB. Welcome to our webinar organized by FinB, the Entrepreneurship and Investment Forum of SICASA. Today, we have the privilege of hosting Mr. Gomathi Shankar, sir, a distinguished expert in the stock market, who will be sharing his insights on the basics of futures and options. Mr. Gomathi Shankar, sir, is a seasoned stock market trader and investor with an impressive background. He holds an MTech in biotechnology from Karpaga Vinayaga College of Engineering and Technology, Chengalpat. His professional journey includes significant roles at Carvey Stockbroking, Spider Software Private Limited, and Zerodha Stockbroking. In 2019, he founded Scalpers Trading Academy, which has been instrumental in spreading financial literacy. Through his academy, he has mentored over 10,000 individuals worldwide. His YouTube channel has dedicated to stock market education, boasts over 150,000 subscribers, and has accumulated more than 7.5 million views. Additionally, he has been featured on platforms like Josh Talks Tamil and Money Control, and frequently he has been called as speaker at trading and investing conferences across India. Beyond his expertise in financial markets, Gomathi Shankar, sir, along with his wife, manages a naturopathy clinic in Chennai, providing affordable and drug-free healthcare services. In his leisure time, he enjoys reading books on self-help, business, and trading, and is passionate about playing cricket and table tennis. We are deeply honored to have Gomathi Shankar, sir, with us today. Thank you for accepting our invitation, sir. Without further ado, I invite Mr. Gomathi Shankar, sir, to take over the session.
Thank you so much, Janani, for having me here on this beautiful evening. So it's always gives me a pleasure to speak among the students, and I have enjoyed it many times earlier. So once again, thank you for giving me this opportunity to feel happy to speak among the young brains. So today we are going to talk about basics of futures and options. So when it comes to futures and options, we have to go behind and we have to talk about forward contracts. So let me share my screen. So before we get into what is futures and options, maybe I will talk about what is forward contract, because forward contract is the base from which futures and options were found. It is like an updated concept. So earlier we were using forward contracts, which is a contract directly between two people, and from that, due to a lot of risk involved in forward contracts, so this futures and options is basically a updated one. So what is a forward contract? So forward contract, it is simply means agreement between two individuals directly for a specific product or for a specific asset. Now let's take we can keep it as a rice, or we can keep it as wheat, or we can keep it as an house. All right. So in this case, let's assume that we are going to do a contract between two parties for buying a house. So when, let's say, I'm going to buy a house, so I will be directly contacting the builder. So here the contract is made between me as well as between the builder. So here two parties are involved. Let's say I'm going to buy a house. So when I'm going to buy a house, there are two parties involved, and one is myself, and another party is the builder. So here the two parties are involved between me and the builder. So this is the main concept of a forward contract. So when we talk about so what does it mean by a forward contract? It is a contract between two direct individuals. Let's say a person A and a person B. So two persons are directly involved for a specific asset. Now, in this case, we are talking about the house. So let's say I'm planning to buy a house. So or you can consider it as a contract or an agreement which we are going to now. Let's say I'm going to buy a house, and only the basement work is going on. In Chennai, most of the buildings are booked in this way. Only the foundation will be happening. Only the basement work would be happening, and most of the units would be sold out. Half of the units will be sold out, and the handover process will take at least 2-3 years. So this is the common thing which is happening in metro cities. So if I'm buying an apartment today in Chennai, so the handover process will be at least 24 to 36 months. So now let's say I'm booking a house. Let's consider in Chennai I'm buying a house, and I'm booking the house for a cost. And the price for the house is, let's say, 50 lakhs. And this 50 lakhs is based on the market value, which is today's market value. Now, based on today's market value, the price is fixed at 50 lakhs. So now I'm booking this house and I'm making the payment. Everything is done. Now, let's say after 3 years, some metro project is coming closer to my apartment, or let's say there is a shopping mall coming closer to my apartment, or let's say there is some government project like any IT parks or any new bus stands which is coming up closer to my apartment. So what happens? The value of my apartment would be increasing. So maybe after 3 years, the value of my apartment would be 80 lakhs or directly 1 crore. There will be a big hike in the prices of the land value. There will be a big hike in the prices of the apartment value. But today I booked at 50 lakh rupees. But when I am booking, what will be the mindset of, let's say we are in 2024, and what is the mindset of me, a buyer, as well as what would be the mindset of a builder? We don't know what is going to happen 3 years down the lane. The builder's mindset will be, I need to sell all the units. The mindset of a builder will be, I want to sell all the units. And apart from that, he doesn't have any other intention. All right. So apart from that, he doesn't has any intention. He has to sell all the units. Right. So his intention is to sell all the units. One second. So his intention will be to sell all the units because he has bought the land, and he has to raise the building, and he need funds to raise the building. So the builder's mindset will be, I want to sell all the entire units. And as a buyer, my mindset will be to buy at a better price. I want to buy at a better price. So here the mindset of the buyer is to buy at the market value, buy at a cheaper price. And the mindset of the builder is to complete the project as soon as possible and to sell all the units as soon as possible. But after 3 years, what happens? As a buyer, I'm enjoying the profits because now my asset has appreciated. But on the other hand, if you check the builder, the builder will be not happy because he already sold all the units at a lesser price. He might have sold all the units for 50 lakh rupees, but once he is about to hand over in 2027, when he is going to hand over the project, the value of the units are increasing, and he would be selling at he has already sold at a cheaper price, so he will not be happy to sell the units. So in this case, in this example, I have talked about myself as well as the builder. So here the parties are directly involved. So that's what we are seeing here. So this forward contract can be customized based on the requirement. Okay. This is an agreement between two parties to buy or sell asset at a specific future date for a price that is agreed upon. And these contracts can be tailored to the specific needs of the parties. So we can customize the contract. We can do some negotiation as we do in a real estate, right? We can ask for a partition wall between the hall and kitchen, or we can ask for an open kitchen. This is what happening in real estate. This is what happening in metro cities. We can, instead of 3 BHK, we can customize the project and we can ask for a 2 BHK. And instead of having a open kitchen, we can ask for a closed kitchen, or instead of having a closed kitchen, we can ask for an open kitchen. So the contracts can be customized because two parties are directly involved. And it's flexible. The contract is flexible. Now, when it comes to what is the trading location, what is the venue of this contract? The venue of the contract is directly involved. There is no exchange, there is no NSE involved, or there is no BSE involved. There is no intermediary. There is no exchange at all. It happens directly between two persons, a person A and a person B. Now, when it comes to a forward contract, it is often physically delivered because I am paying the money and the goods sold here is a house. So I need the physical delivery of the asset. If the physical, it depends on the asset classes. Now here, if the contract is, since the contract is house, then I need the delivery of an house. And if in case if the contract is for a rice or wheat or corn, then I need the physical delivery of that particular instrument. And once the contract is over, the settlement occurs. Now here in this case, I'm booking a house in Chennai in 2024. And the handover process is on 2027 after 3 years. So the contract ends after 3 years. The builder will hand over the flat to me, apartment to me, and I will be happy to, give him the pending dues or any settlements. If it is there, I would be happy to settle it. So now here the problem with the forward contract, when two parties are directly involved in a forward contract, the problem is it is of high risk, because one person or the other person may cancel the contract anytime. Now let's say I'm buying a house in Chennai, I'm booking a house today, and my handover is on 2027 after 3 years. Now let's say after 1 year, there is a drainage project coming closer to my apartment. Drainage project is coming. So what happens? A drainage or a sewage treatment plant is coming closer to my apartment. So it is more of a bad news for my locality. Just assume there is a big apartment complex and nearby there is a sewage treatment plant, or nearby there is a sewage drainage is there, or nearby there is a graveyard. So these are the negative things which will affect a apartment, which will affect the prices of an apartment. So if this kind of a negative thing happens, then I would like to cancel my apartment booking. I don't want the apartment. I want to cancel the booking. So in that case, what happens? It is a risk for the builder, because it's my right to cancel the apartment. He might deduct the cancel. He might take some cancellation charges or anything, but he has to return the remaining money. So here the risk is there. Now let's say the builder has promised to deliver me the apartment on 2027. And what if he delivers after 1 year? What if he delivers on 2028? What if the builder has defaulted? What if the land is on a legal issue? What if the builder is having some legal issue? And what if the construction process stops all of a sudden? What if there is a huge delay in delivering the apartment? So when a contract is involved between two persons, you have to understand there is always there is a risk of default. Anybody can any person can default in any case. And it is less. And why these kind of risk is there when two parties are involved? Why there is a huge risk when in a forward contract? Because there is no proper regulation. That is the major issue. So now when it comes to futures contract, so from forward contract only, this futures contract is updated. It's like an upgraded version. Now, once upon a time, we were using Nokia 1100, and then we started using basic touch phones. And then now we are using far advanced mobile phones, smartphones. So once upon a time, we were using Orkut for chatting, and then we were using Facebook. And then now we are having WhatsApp, Instagram for chatting purposes. So similar way, from forward contract, this futures contracts are upgraded. So now when it comes to a futures contract, it's a standardized agreement. There is a lot of rules and regulations. There is a lot of protocols. There is a lot of terms and conditions involved in a futures contract. So that nobody is defaulting at any point of time. There is no chances of any risk. Okay, you cannot escape. So this futures contract is a standardized agreement. This is a standard agreement traded on an exchange. So if you check earlier, when it comes to forward contracts, there is no exchange involved. But this futures contracts are traded on an exchange only. So you have to buy or sell an asset at a future date. Now, once again, now let's say I'm booking a house today. And the delivery is on 3 years later. So this buying process is completely regulated by the exchange. And this is where NSE and BSE comes into play. All right. So this is why NSE is there. NSE as an exchange is there. And even BSE is also there. So when it comes to regulation, there is a lot of terms and conditions, as I said earlier. So there should be a fixed amount of quantity. There should be a proper delivery date. And there should be a minimum price increment. So what is the price at which I am buying? So when it comes to, and moreover, as we saw earlier, the trading venue is exchange. As I said earlier, NSE is the example for us. And settlement and delivery. So mostly this futures contracts are cash settled or physically settled. I need the physical product or I need to settle it through cash. So most of the futures contract which is trading in NSE is cash settled only. We will not get any physical delivery. So the major reason why futures and options were introduced was as a hedging tool to reduce the risk of losing my money. Now let me take an example. Now let me go to any mutual funds. Okay, let me take like SBI large cap fund. All right, so I'm taking an example. I'm taking an example of a mutual fund. So it could be any mutual fund. So I'm coming down to the let me select a different fund. All right, so we can have a look at this particular fund. So we are looking at ICC Prudential Blue Chip Fund. Let's have a look at this particular fund. I wanted to talk about why futures and options are introduced. So primarily futures and options are introduced for hedging purposes. Now, if you look at this ICC Prudential Blue Chip Fund, this particular mutual fund has invested almost 55,000 460 crores in our Indian markets. Okay, just look at the numbers. Just imagine the numbers. Almost 55,460 crores has been invested in a equity market, especially in large cap funds. So that is a huge number. And if we look at the top holdings of this particular fund, so these are the top 10 stocks which are bought under this ICICI mutual fund, ICICI Prudential Mutual Fund. So this mutual fund has invested in ICICI Bank, Reliance Industries, L&T, HDFC Bank. So almost all the 10 companies which are here in their portfolio belong to large cap category. Now I want you all to look at the quantity. I want you all to look at the quantity, which means the number of shares. So nearly this mutual fund is holding closer to 4 crore shares in ICICI Bank, and this mutual fund is holding closer to 1.4 crore shares in Reliance Industries, and this mutual fund is holding almost 1 crore shares in L&T. So this mutual fund has been investing in large cap stocks, and they are holding crores of shares, and their value is in huge numbers in each and every stock. Now, what if the market crashes? What if the market corrects by 10%? What happens during COVID? There was a crash. And what happened on election date? There is a huge fall in the market. So in those cases, just imagine this mutual funds. So what happens? They would be in a huge losses. They are having all these 10 companies are in Nifty 50. So they are holding all the Nifty 50 stocks. So what if when the market corrects by 10%, all these companies will be in huge losses, and there will be a huge loss in the portfolio of this mutual fund. So they have to reduce the risk, right? They have to reduce the risk of losses in their mutual funds. Otherwise, they will be questionable to the investors. Retail, all this 55,000 crore which is there in this fund is retail people's money. We have invested in this particular mutual fund. So if there is a crash in the market, and if this mutual fund is making losses, then investors will question the mutual funds. Investors will not be satisfied with the mutual funds, and investors will not be happy with the government as well, because mutual funds are regulated by the government. Mutual funds are regulated by the AMFI, and AMFI comes under SEBI's regulation, and SEBI is under the control of the government. So people will not have a belief on the government. So there will be a economic collapse. So in this case, what has to be done is people's trust should be protected. So what will happen? These mutual funds will take a counter position in futures and options. In order to reduce the losses, they will take a counter position in futures and options. That's why futures and options are derived. So why derivatives trading has been introduced? So from the underlying asset, the underlying asset might be a stock, a company, or Nifty or Bank Nifty index, or it might be crude oil or gold. So from the underlying asset, derivatives has been introduced. Okay, futures and options are introduced. And the primary motive of introducing futures and options is for hedging purposes. Only for hedging purposes, this futures and options have been introduced. Now, this hedging is primarily done by institutional players like mutual funds, insurance companies, banks, and by FIIs, FPIs. So they does the primary thing of hedging purposes, and even institutional players, even prop desk, and even institutional traders with huge capital, even they does the hedging part. All right. So any type of contract or agreement which has an expiry is termed as the futures and options contract. Now, let's say, as we discussed in this example, we saw that this ICICI Prudential Mutual Fund has invested in these following companies. And if these companies are coming down, this mutual fund will be in a huge loss. So what happens? What happens? The mutual funds will take a counter position in futures. Let's say they will short futures and they will make money out of it. And even in options, they will be taking a preferable position. Please give me a minute. All right. So they will be taking a counter position in futures as well as in options to safeguard their position. So initially we saw about the forward contract, which is a contract between two parties. So there is a huge risk involved because there is no regulation at all. But when it comes to futures and options, it is completely regularized. Okay, you have to buy a fixed quantity, and there is a proper delivery date, and everything is taken care by the exchange. The buying process, the selling process, and the settlement process, everything is taken care by the exchange. All right. And mostly our Indian stock market, everything is cash settled, and there is no counterparty risk at all. The risk of default is there is no chances of default because it is taken care by an exchange. So the reason why futures and options are introduced is for hedging purposes. There are hundreds of mutual funds, and all the mutual funds have invested crores of money in stock market, in equity market. And if there is a correction in our equity market, let's say 10% or 20%, or let's say during the COVID times, the market was having a crash. So in those kind of situations, the investors' trust has to be protected. The investors' money has to be protected. Our country's economy has to be protected. So these mutual funds will take a counter position. They need some kind of tool to take a counter position and to make money from the market fall. And that tool is called as the futures and options. So futures and options, so they will not sell the holdings in a loss. Let's say this mutual fund is holding top 10 stocks. These are the top 10 stocks. Now, let's say there is a crash in the market. Immediately, they will not sell away all the shares and immediately they will not run away. They will not book the losses. So instead, what they will do, they will take counter position in futures. Let's say they will take a short position in futures and they will make a money out of it. So this is why futures and options are primarily introduced in our markets, and forwards is the underlying thing which has been an inspiration for bringing the futures contract. So if you look at the key differences over here, so forward contracts are highly customizable because only two parties are involved. They can do any kind of customization. But futures is a standard contract you cannot customize. You have to buy a fixed amount of shares only. Now, let's say I will go to ICICI Bank. So I'm going to ICICI Bank and I will go to the derivative section over here. So this is NSE India website. I'm going to ICICI Bank and the derivative section. So here I will turn on the stock futures. So here you can see the stock futures contract of ICICI Bank, which is basically June contract. So this is how you read the futures contract. So the instrument which I have selected is ICICI Bank. And here is the expiry day. So June month expiry, which is on 27th. All right. And this is the price at which the futures contract is trading currently. And here you can see something called as market lot, which means I need to buy minimum 700 quantities of ICICI Bank. The quantity is fixed. I cannot change this. When it comes to forward contract, now let's assume forward contract. You can customize everything. You can buy 7 shares. You can buy 70 shares. I'm just telling for an example. So when it comes to a forward contract, you can customize as you wish. And there is no proper expiry date. There is no fixed quantities. But when it comes to futures contract, the quantity is fixed and the expiry date is also fixed. You cannot change that. So these are the key things which you have to note it down. So the market, so you have to buy, if you are buying ICICI Bank futures, let's say you are having a bullish view in ICICI Bank. Now let's say ICICI Bank has posted some good numbers in the Q4 results or annual results, or let's say there is some good positive news for this ICICI Bank. So what happens? There will be an anticipation that the share prices will increase. So let's say since the share prices are anticipated to increase in future, let's say you buy ICICI Bank futures. So you have to buy 700. The quantity is fixed. You have to buy 700 shares. And as per the last traded price, you have to pay the money. So the last traded price is 1,154. So if you want to buy this ICICI Bank futures contract, you have to multiply that 1,154 into 700. So the contract size is 8,07,800 rupees. So the total contract value of this ICICI Bank futures is 8,07,000. However, there is a margin requirement, like you need only 10% or 20% of the margin to buy this futures contract. Generally, brokers are having that kind of margin requirement. You no need to pay the entire 8,07,000 rupee. You need to pay only 20% of this margin, or you have to pay only 30% of the margin. It depends on the instrument and it depends on your broker. So let's say you need only 20% of this margin. So you have to pay 1.61 lakhs, 1,61,000 to buy this ICICI Bank futures contract. So all these processes are fixed, it is regulated, including the margin requirement, including the minimum quantity size, including the expiry date. So in our Indian markets, the expiry of all the stock futures and all the index futures are at the last Thursday of every month. So this month, the last Thursday is on 27th. So we are having the expiry date on 27th of June. On July, the last Thursday is on 25th. So you are having you can see the date along with the month. And in the month of August, you are having a last Thursday on 29th. So all these processes are regulated. That's the reason why it is traded at an exchange. And that's the reason why it is highly regulated. And there is a lower risk of default. Nobody can escape. Okay. Let's say I'm buying ICICI Bank futures contract. I cannot escape without selling. Or I cannot buy without paying money. Similar criteria for sellers. Okay. They has to deliver. They has to buy it back. And they has to pay the margin back. So these things are regulated, and these things are standardized when it comes to a exchange. So primarily futures as well as options are introduced for the hedging purposes. So in our Indian markets, futures contracts are of less interest. Options market is playing a very, very major role in our Indian markets. Comparing with futures volume, there is a huge volume in the options volume. Okay, and our Indian markets, our NSE is the largest derivatives market in the world. Okay, the largest derivative market in the world, and continuously for 4 years. Continuously for 4 years, Indian markets has been the leading market across the world. So now let's look at some few more things. So these things we already saw. So you can just have a quick glance of it. So what is hedging primarily? What is hedging? So let's say you are holding XYZ company shares for 5 lakh rupee. You have invested 5 lakh rupee in a XYZ company. Now, example, if the company delivers a poor quarterly result, or if the company defaults in any legal cases. Now, let's say the quarterly results are not satisfactory, or let's say there is a issue with that particular company. So what happens? The company share prices will decrease, and your holdings 5 lakhs will be in a loss of few lakhs. You will lose your money. You have invested 5 lakh rupee, there are higher chances you will lose your money. Your money will depreciate. So in order to recover the losses in your holding, you need some alternative way. You need to protect your losses. Now let's say you have invested 5 lakh rupee. The quarterly results are poor of XYZ company. And let's say there is a gap down opening in the market. And let's say your portfolio is in a loss of 1 lakh rupee. You have invested 5 lakh, now your portfolio is just 4 lakh rupee. You cannot exit your holdings. You cannot book 1 lakh rupee as a loss. Because 1 lakh is a huge loss. You cannot book it. So in order to recover the loss, you need some alternative ways to protect your portfolio. So now you can take a counter position in futures and options. You can short futures, or you can buy any of the options, and you can protect your portfolio. So I'm holding shares for 5 lakh rupees. I'm anticipating that this particular company will post some less Q4 results. The Q4 results may not be satisfactory in this company due to this following issues. So what I can do is I can take a counter position in futures. I can take a short position in futures. I can sell in futures. So in case if the company goes down, I have shorted in futures, I have taken a counter position in futures, and that futures will make money for me. So this is the reason why hedging is introduced. This is called as hedging. You are protecting your portfolio by a different instrument. That is the futures and options in this case. So now this is a simple example for an hedging. I'm giving you a very simple example for a hedging. What to understand hedging in a better way. Now let's say you are buying a house, and which means you are buying ABC shares. And let's say you have to pay monthly EMI. Okay, let's say you are buying house and you have to pay monthly EMI. So I'm buying a house for 50 lakh rupee and I have to pay a EMI of 20,000 or 25,000. Now let's say I'm renting my house. Okay, instead of I'm buying a house, and what I'm doing, I'm renting my house, or I'm renting a portion of my house. I'm buying a house which has one floor or two floors. Let's say I'm residing at the ground floor. I'm residing in ground floor with my family, and I'm selling the first floor. I'm renting my first floor and second floor. So I will get rent from the first floor. I will get rent from the second floor. Using that rent, I'm using the rental income from the first floor and second floor. I am paying the EMI. So this is called as hedging. If you check the examples given in the brackets, let's say I'm buying ABC shares. I have to pay EMI. Let's say there is a temporary bad news for the company and I'm in a loss. So because of the bad news of that company, the company is going down. So I'm taking a counter position in ABC company in futures and options. Let's say I'm taking a short position in futures. Okay, I'm taking a short position in futures. So now the profit which I have made from the futures will recover the loss from the ABC company shares. Already the ABC company shares I am in loss of 1 lakh rupee. Let's say, for example, I am taking a counter position in ABC shares in futures, and the profit from the F&O will safeguard the losses in my portfolio. So this is one simple example of a hedging technique. So this we already saw about futures trading. So when it comes to forward contract, the contract is made directly between two person. There is a chances of huge counterparty risk. But when it comes to futures contract, it is an organized contract regulated by the Indian markets, by the exchanges. And since it is regulated, there is no risk of default. Nobody can escape. All right. So generally, in futures and options, there are three types of contracts. So there is a near month contract, and there is a next month contract, and there is a far month contract. Now let's say the current month contract is February. The next month contract will be March, and far month contract will be April. Okay, so that is what given. Generally in futures and options, we have 3-month contracts only in our Indian market. Okay, if you are, let's say you are planning to buy futures in any company, you can buy for 3 months only. That is what we saw in this NSE website as well. So this is ICICI Bank. If you are planning to buy ICICI Bank futures, you can buy for this month, you can buy for next month, July, and you can buy for the far month only. You cannot buy beyond that. So that is what we have given in this presentation. Now let us come to options basic. So options is, as I said earlier, our Indian derivatives market is the largest derivatives market. So let's say you are having a bullish view in a company. So generally you might have been knowing that there is, so generally you might have been knowing this. About the options, you know about call option and put option. Clear? So let's say you are bullish in a particular company. Then you will buy a call option. So what does it mean by a call option? Let's say you are bullish in a particular company, you are expecting the company's prices to increase. Then you will be buying a call option. Now let's say you are expecting the company prices to decrease. Then you can sell that particular call option. So in case if you are expecting, let's take an example of ITC. So let's say you are having a bullish view in ITC. So then what you can do is you can buy a call option. Now let's say you are having a bearish view in ITC. Then you can sell a call option. So if you are bullish, you will buy a call option. If you are bearish, you will sell a call option. Now otherwise, let's say you are bearish in ITC. You can buy put option also. You can buy put option also, having a bearish view. Or you can, if you are having a bullish view, you can sell put option also. So this is the general thing which we have in options. All right. So in India, more than futures, options is having more volume and interest. Because in futures, you can either take only call option or put option. And in futures, you need to be directional. Now, why people are showing less interest in futures and why people are showing more interest in options? Because when it comes to futures, you can do only two things. You can buy futures or you can sell futures. Now, if you are buying futures, it means you are having a bullish view. You are expecting the company of that, you are expecting that particular company to go up. Now, when you are selling a future, you are expecting the share prices to come down. But what if the company remains sideways? There is a third chances. There are three trends in the stock market in general: a bullish trend, bearish trend, and a range bound market. Now, what if the company remains range bound? In that case, futures you will make losses. So that's why options have been introduced. In options, there are a lot of options for you to recover your losses and to protect your profits. So as I showed in the earlier slide, in options, you can buy call, you can sell call, you can buy put, you can sell put, you can do a lot of strategies to protect your portfolio, even in a range bound market. So in options, if the market is bullish or if the market is bearish or if the market is range bound, in any kinds of market, you will be in profit. There are strategies for that. So options buying, when you will make profit. Now let's say, as I said earlier, let me come to a small example. Come to a small example. Let's say I'm buying ITC share. I'm investing 5 lakh rupee in ITC company. Okay. So I'm investing 5 lakh rupee in ITC company shares. Now let's say there is some market crash. Let's say there is a market crash. So what happens? The price of ITC shares will come down. Now let's say I am in a loss of 1 lakh rupee. So let's say I'm in a loss of 1 lakh rupee. And let's say now my portfolio is 4 lakh rupees. I've already incurred a loss of 1 lakh rupee. Now I am in a Now my portfolio is just 4 lakh rupees. Now I am taking a counter position in futures. So what I will do, I will sell futures, ITC futures. I will sell ITC futures. Having a mindset that if ITC goes down, I will make money. Now let's say once I sold ITC futures, ITC did not fall. Okay, ITC is not falling. ITC is now when there was a crash, ITC prices came down. So now once the crash has happened, I'm selling ITC futures after the crash. Now ITC is not moving at all. Now ITC is moving in a range bound manner. Now what happens? In futures also I will make losses. And again, I will make another 1 lakh rupee loss in futures. And now my portfolio will be down to 3 lakh rupee. So finally, I will be in a loss of 2 lakh rupees. Because I lost 1 lakh rupee in equity cash and I lost 1 lakh rupee in futures. Whereas when it comes to options, in this scenario, once the crash has happened, I can do a lot of things. Like I can sell call options. I can sell call options. I can buy put options. And even I can sell puts also, assuming that ITC will not fall beyond this particular level. Now let's say ITC is trading here and ITC is coming down. I can sell call option here. I can sell call option here. Everywhere I can sell call option. At the same time, I can sell put option here also. Assuming that ITC will not fall further. Assuming that ITC will not fall beyond this particular level. So I can sell puts here. I can sell puts here. So now when ITC is range bound, as we discussed in the futures example, I will make profit from the call option, sold call option, and I will make profit from the sold put option. So when it comes to option, you can make money in 3 directions. When the market is bullish or when the market is bearish. So when the market is bullish, I can make money. When the market is bearish, I can make money. And when the market is sideways, I can make money. So in 3 modes, I can make money. But when it comes to futures, I can make money only in a bullish market or I can make money only in a bearish market. In a range bound market, I will lose money in futures also. So this is the major difference between futures and options. All right. And of course, the margin requirement for options is very less. That is a different thing. But first of all, let's try to understand the major difference. This is the major difference. Now here I am giving a small example how you will make money in options. Now let's say there is a 30 lakhs worth of house. The house owner is asking me 1% token advance. Okay, 1% token advance. Now let's say I want to arrange funds for 30 lakh. Immediately I cannot take 30 lakhs from my pocket and I cannot give to the house owner. So I'm asking time to arrange the funds. So I'm giving 1% token advance, 30,000 rupee to the house owner. Now let's say a news is coming, a shopping mall is coming near. Okay, let's say the value of the house is fixed. The value of the house is fixed as 30 lakh rupee. I've already given the token advance. Everything is done. Now let's say a shopping mall is coming next to my house. So now the house value will increase to 50 lakh rupee. Example. So now what happens? My token advance price also increases to 50,000. Yes or no? House value has increased. So 1% of house value is 50,000. Now what I will do, I've already booked my house for 30,000. Now I will buy the house. I will arrange funds immediately and I will buy that particular house because the value of the house has increased. Okay. The value of the house has increased. As a result, I have made a profit of 20 lakh rupee on the value of house, and I have made a profit of 20,000 on the value of the token advance. So I have saved my money. I bought at a cheaper price. Now, if I want to sell my house, I can sell at a higher price. I will receive a token advance also at a higher price. So this is a very good example of an option buying. I know. Now let's say now when I will make a loss. Now let's say a same example. 30 lakh worth of house. I have already given a token advance of 30,000. Now let's say there is a cemetery, a graveyard is coming up next to a house. So nobody will buy a house nearby a graveyard. Or let's say there is a sewage treatment plant is coming. So nobody will buy a house near sewage treatment plant. So now the house value decreases because of this negative news. Now 1% of my token advance also decreases to 10,000 rupee, obviously 1% of the house value. Now, if I am refusing to buy the house, let's say, no, I don't want to buy the house, okay, because of the sewage treatment plant. I am not interested in buying the house. Let's say I am refusing. So what happens? The house owner will not return the 30,000 rupee because they generally they will not refund. It is a refundable deposit. It's like a refundable token advance. So most of the house owners, they will not return the token advance money. It's something like non-refundable. So what happens? I'm losing only 30,000 rupee. Correct? I'm not losing 30 lakhs. I'm losing only 30,000. So I will not buy this house because the value has decreased. Instead of losing lakhs of money after buying the house, I will lose only 30,000 and I will break the agreement. So this is when you will lose the money in options. You will buy the option at some price expecting the company to go up. But if the company is not going up or if the company is staying in a range bound manner, in a sideways manner, then you will lose only that particular options amount. All right. So here I have given the example of the strike prices. Now I have given a very, very simple and funny example. Now let's say you are thinking that Nifty will go up. Okay, and you are now let's say Nifty is at 10,000 rupee. Okay, right now Nifty is around 23,000 levels. But this is for an example. Let's say the Nifty is at 10,000. You are buying a call option, thinking that Nifty will go up. So you are buying a call option. And you are buying a strike, you are buying 10,000 strike price and the premium is 1,000 rupee, for example. Now, let's say India wins the World Cup. This is just a funny example. Let's say there is some good news for our country. Now, let's say Nifty is going from 10,000 to 12,000 because of the good news. Now, your call option is also doubling. From 1,000 rupee, the call option is going to 2,000 rupee. So now you have made a profit of 1,000 rupees, correct? So what you will do, you will book your profit. You will book your profit because Nifty value has increased, your call option value has also increased, and you will be in a profit of 1,000 rupee. So this is when you will make money in option buying. So this is a example. This is a straightaway example of strike prices. Okay. So in general, this is another example in the slides which will help you to understand further about the options. So options is like buying a insurance, or options is like giving a token advance for the house. We saw an example here. 1% of token advance on 30 lakh rupee worth of house is 30,000. So options is buying a insurance. So an option selling is like a insurance seller. An option buyer is like a insurance buyer. So why we are buying insurance? Because we want to protect ourselves from a bigger danger, right? So we are paying some premium, a small amount, and we are buying our insurance. And option selling is like an insurance seller. Okay. So think about an insurance seller. He is collecting premium from all the insurance buyers, but lakhs of people are buying insurance, but only few hundred people are taking the availing the insurance, right? Because only few hundred people will fall sick. Only few hundred people will face some bigger medical expense. So at the end, insurance seller is making money. So this is the small difference between option buyer and seller. We are buying an option anticipating that the stock prices will go up. Even if the stock prices are not going up, I'm okay to lose a small amount. But option selling is like I'm collecting a small money on the overall, on in general, I will be making money because I'm selling in a large scale. So this is a small difference between option buying and selling. Okay. So here I will show you the option chain of ICICI Bank. So earlier we saw the futures contract of ICICI Bank. So now we are looking at the options contract. So this is derivatives. Under derivatives, we are looking at the under futures, we are looking at the stock futures. Now, we can check the stock options, and here you can check the strike prices. So this is what we call as strike prices. Okay, and it is decided by, as I said, it is decided by the exchange. The strike prices and the market lot is decided by the exchange. Now here this currently ICICI Bank is trading at 1,157. So currently ICICI Bank is trading at 1,157, right? And here you can see the strike prices. This is how you select the strike prices. So I'm expecting ICICI Bank to go up above 1,157. So I can buy 1,160 call option because I'm expecting ICICI Bank to go up. So basically this is call option. This belongs to call option. And this belongs to put option. Okay. If I'm expecting ICICI Bank to go up, I can buy this call option, which is trading around 7 rupee. Now let's say I'm expecting ICICI Bank to go down below 1,157. Then I can buy this 1,160 put option, which is trading around 12 rupee. So this is how this is like the strike prices are like a house. Okay, this strike prices are like a house worth of 30 lakh rupee as an example. And the strike prices, and the price of the strikes are like token advance. token advance, let's say 1%, as I said in my example. So all the strike prices which you are seeing in between are called, you can consider it as a house. And the last traded price over here in the center, you can consider it as a token advance, 1%. Similarly, for put option, you can consider this last traded prices as a token advance for that particular strike price. So if I want to buy, so let's say if I want to buy 1160 call option. Let's say I wanted to buy 1160 call option, then I have to purchase at 7 rupee as a token advance. And let's say I wanted to buy 1160 put option, I have to purchase this put option at a 12 rupee as a token advance. So this is how call option is traded, and this is how you look at the call options. So this is a difference between the call option and put option. So here you can see difference between call option and put option. So if in call option, if the stock goes up, the option prices goes up and the buyer of the option makes money. Option buyer makes money. Now in put option, if the stock goes down, let's say I'm bearish in, let's say I'm thinking ICICI Bank will come down, then I can buy a put option. So what happens? My option prices, which means the token advance amount also increases. Then I will be in a profit. I'm buying at 10 rupee. I'm buying put option at 10 rupee. And ICICI Bank is coming down. This 10 rupee will go to 15 rupee or 20 rupee. So I will make money. So these are the examples of strike prices. And so this is another example when you should buy and sell an option. Let's say you are buying call option because you think the stock price will go up. Even if up, you need not make money. So buy call if stock will go up. Okay, so if you are expecting the prices to go up, then you have to buy a call option. If you think the prices will not go up, then you can sell a call option. Let's say ITC is there. Let's say ITC is trading at 400 rupees. Okay, you are expecting ITC to go above 400 rupees. Above 400. Above 400. Then you can buy a call option. Now let's say you are thinking ITC will not go above 400. It will not go above 400. 400 will be the highest point. ITC will not go above 400. You are having a view. Then you have to sell call option, which means you have to sell 400 call option. The meaning is ITC will not go above 400. Now same way, you are expecting ITC to go down below 400. Then you can buy a put option. Now let's say you are expecting ITC to not go down below 400. ITC will not go below 400. 400 will be the last level. ITC will go up. You are thinking like that. Then you can sell put option. You can sell 400 put option in ITC at whatever price it is trading. So this is how buying and selling of call and put option works. All right. So ultimately, these futures and options are introduced for hedging purposes. All right. So I think we are done with the session. So we have discussed about the importance of futures and options, the basics of futures and options, why futures and options are introduced. So basically, futures are introduced from the forward contract. Forward contract is basically a contract between two persons directly. But futures is a standardized contract. Now there is only one disadvantage in future, which means I cannot make money in futures if the market is sideways. So for that purposes, options has been introduced. And in options, we saw what is call option and what is put option, how to select a strike prices. Okay. In options, in general, in options, I can make money from call option. I can make money from put option. If the market is going up, I can make money. If the market is coming down, I can make money. If the market is not going up, I can make money. If the market is not coming down, I make money. And if the market is range bound, I can make money. So there are a lot of options in options to make money. That's why options is preferred by most of the traders across the globe, especially in India. The volumes in options have been skyrocketing year on year, and the interest in futures market is very less in recent time because of the wide variety of options available in options trading. And again, options trading of both futures and options, both are highly regulated. There is high liquidity and there is no counterparty risk, and everything is cash settled. So this is the basics of futures and options. Now, if you are having any questions, you can ask me regarding the same. So generally, we can take a couple of questions and we can wind up the session.
Yes, sir. So, what is basically call and put option is what some questions we have asked, because some of us don't know what is call and what is put.
Okay, now let's say you are assuming that the stock prices will go up. Let's say you are expecting a particular company to go up. Okay, so in that case, you can buy a call option. So call option is like an option that you are expecting the prices to go up. So it's like you can assume it is like a token advance. You can you are buying a token. You are paying some amount to block that particular contract. Okay, let's say ITC is going to be now. Let's say ITC or any particular company is going to be bullish, and we are expecting the prices to go up. So in that case, I have to buy a call option. So call option is like it's like a token advance that I am expecting this particular company. I no need to buy that company. Now let's say ITC is going up. I no need to buy 100 shares or 200 shares. What I can do is I can buy the contract in call option, assuming that ITC will go up. So once ITC is going up, I will make money from the call option directly. Okay. And similarly in put option, let's say I'm expecting ITC to, let's say I'm having a bearish bias in ITC. I no need to go and short in equity market, or I no need to take a short position in futures market. I can just buy a portion of the put option. And once ITC goes down, I will make money from the put option. So basically, if you are having a bullish bias, you can buy call option. If you are having a bearish bias, you can buy a put option. So that's it.
And regarding if someone wants to start trading in options, so what will be your basic do's and don'ts? Like if someone who's starting out and they have the basic knowledge.
So if anybody is just getting started into trading, first he has to trade in equity cash. So he has to the first thing he has to do is he has to do short-term investing. Okay, he has to look at the charts and he has to have he has to do some basic technical analysis, and he has to do some short-term investing for first 6 months to 12 months in equity cash. So once he has been successful in equity cash, in short-term investing, then he has to shift to swing trading. You might have heard about, generally, UCA people will be doing a lot of fundamental analysis. And this fundamental analysis will be helpful for long-term investing and value investing. Now, when it comes to trading, when it comes to technical analysis, this technical analysis can be helpful for a short-term momentum investing. There will be a short-term spike in prices. Now let's say the quarterly results are good. Then the next few weeks there will be a increase in prices of the shares. The next few months there will be an increase in prices of the shares. As a trader, as a technical analyst, I don't care about the long-term projection, what will happen after 3 years or 5 years or 10 years. My projection will be for the next few weeks to few months. So This has to be done by a newcomer in the market. So first, he has to do short-term investing for 6 months to 12 months. Once he has been successful in equity cash in short-term investing, then he has to shift to swing trading. So swing trading is basic. Now short-term investing is basically for few months, and swing trading is basically for few weeks. So he has to do swing trading for in equity cash for few weeks. Once he has been successful in equity cash in swing trading, then only he has to shift to options trading. Because this derivatives trading, it needs a lot of expertise. It needs a lot of emotion control. Apart from knowledge, it needs a lot of other things like emotion control, discipline. It needs some strong risk and money management practices. It needs some good knowledge and experience about the market itself. Okay, it's not like I'm learning today and executing it tomorrow. It's not like that. It needs a lot of real-time experience. That's the reason asking the newcomer to do short-term investing and then swing trading and then come to options trading.
Yes. So, sir, another question is like if we are getting into starting to trading. So, first, initially, should I put my own money and start with trading, or should I do with virtual trading and then slowly I proceed to investing, like trying to buy one lot? Is that how someone should start, or is there any steps like how someone should start with it?
See, generally my advice would be don't do paper trading, don't do virtual trading. It's like you are practicing swimming on the floor. It is of no value. If you want to learn swimming, you have to jump into the swimming pool. No other way. Okay. If you are just sitting on a table or if you are just sitting on the bed and if you are practicing swimming, it is of no use. So, similar again, if you want to play any sport, you have to go to the field. If you are playing cricket, you have to get into the field and you have to practice with the real bat and ball. You cannot just play a cricket game and you cannot plan to go to the field and you cannot plan to hit sixes and boundaries. So my personal advice will be stop doing virtual trading. Don't do virtual trading. Don't do paper trading. You can just start with few thousand rupee. You can start with 1,000 or 2,000 rupee. Just practice buy and selling of small quantities of any shares. There are a lot of companies. There are a lot of good companies which are available with less than 500 rupee. Okay, lot of PSU companies are available at cheap prices, which is trading below 500 rupees. You can practice those companies with few shares, 1 or 2 shares you can buy and sell, and you can do some live market practices. So this is what I will personally advise. And no need to think about futures and options right now. I want everybody to do equity trading for at least 1 year, and then only you have to think about derivatives trading, because derivatives trading are very, very risky. Recent times, derivatives trading has been very, very difficult for even experienced players. So beginners should not think about futures and options trading right now.
Yes, sir. Another question is, so recently the market has been very volatile, and one person has bought 51,500 call option in Bank Nifty, and the premium was around, okay, the stop loss was around 275 levels. The stop loss got triggered when it went down to 210 levels, and then again in half an hour it went back to 500 level. So in such a case, so what would I do? Because after an half an hour my stop loss is hit, it has given me a profit. So is it always correct to have a stop loss, or how to correctly place a stop loss?
See, recent time, since the election results, recent time, the market is very, very volatile because the market is waiting for the first union budget to be announced. Okay, so next month we are having the budget of the newly formed government. So, what are the sectors going to be beneficial, and what are the sectors going to be badly affected? And is there any hike in taxes or is there any relaxation in taxes? So, lot of and in terms of GST is also there is a lot of buzz going around. So, the market all the institutional players, FIAs, DIAs, all the institutional players are eagerly waiting for the first budget only. So till the first budget is over, there will be huge volatility in the market. So it's advisable not to take any huge position in options or in equity cash. Okay, so my request would be people should trade with very less quantity in options, and they should trade with strict stop loss. So now recently on Friday the market has been very volatile. If you are taking a call option, it is hitting your stop loss. If you are taking a put option, it is hitting your stop loss. Again, if you are taking a call option, again it is hitting hitting a stop loss. So this wild move is happening because of this reason only. Market is waiting for the budget. So until budget, either people can avoid trading or stay with very less quantity as possible, or avoid intraday trading and focus more on swing trading. So this is the best advice which I can give.
Okay. Another question is, so if some say that when starting with the options, so it's better to buy the call option morning and then wind off the position by evening, and it's not advisable to carry it for a couple of days. Is that right, or is that it's just another way?
See, it depends on the which method we are following. There are few methods where I can buy call option today and I can sell today itself. And there are methods where I can buy call option today and I have to hold it for at least 1 or 2 days. So there are a lot of methods which we call as trading strategies. So there are a lot of trading strategies. So based on the strategy, the holding period differs. So both are true, and both are true, and it applies based on the strategy which he or she is following.
Okay. So the another question is, at times call option premium and put option premium simultaneously gets deteriorated. At such a situation, how should one handle it?
Okay, at some cases, both call option and put option both are decaying as much as possible. Now, let's say the call option price is 100 rupee and let's say put option price is 100 rupee. And at some point of time, what happens? Both the premiums will decrease. Though the market is going up or though the market is coming down, the premiums will not increase. The premiums will decrease. It's happening because of the volatility index, which we call as India VIX. So because of India VIX, which is called as a fear index. Okay. So whenever the India VIX is very high, the premiums will be very high and the decay also will be very high. All right. So whenever the India VIX is very low, the premiums will be very low and the rise in premium will be very high. So there is a couple of factors involved into it. One is India VIX and another one is time to expiry. So whenever the expiry date is coming closer and closer, based on the asset. Now let's say Nifty is having expiry on Thursday and Bank Nifty is having expiry on Wednesday and FinNifty is having expiry on Tuesday. So based on the time to expiry also, the premiums will decrease drastically. So based on these couple of factors, this event happens. Premiums will gradually deteriorate.
Another question is, which is better according to you? Is it like buying a call option or buying a put option? Like option buying or option selling? Which is considered to be better?
See, my view will be you should be an opportunist. You should be adaptive. Now, what we are doing in summer season and what we are doing in winter season. Very simple. So same way, at times we have to be an option buyer, at times we have to be an option seller. So right now, India VIX is very less and the premiums are very less. So we have to implement option buying as well along with option selling. So now since the India VIX is very less, I have to do more option buying and I have to do less option selling because the premiums are very less. Whenever India VIX is very less, the premiums will be very less. So even if I am doing option selling, I will not get enough premium. There will not be chances of making huge profits. So I have to do a lot of option buying and I have to do a lot of option selling as well. I have to do a little bit of selling as well. Now, whenever the India VIX is very high, now during the election results, the India VIX is very high So in that case, the premiums will be very, very high. So in option selling, I can make a huge money. So what I have to do is I have to do a lot of option selling and I have to do a little bit of option buying. So this option buying and option selling both should be done in equal proportion based on the market condition. All right. And again, it depends on the trend as well. Now, Nifty has been in a range bound manner. If you look at the technical analysis chart of Nifty, Nifty has been trading at some particular level for a very long time. There is no drastic move. There is no breakout in Nifty. So in this case, option buying also has to be reduced because the trend is range bound. Nifty is not moving at above a certain level. So it depends. So option buying and selling both has to be done. We have to be adaptive according to the market condition. And again, it depends on various factors like trend as well as India VIX as well as the premium pricing. So it depends on these factors.
So there's a follow-up question. Option selling is very risky, but the loss in option buying is limited. So in that case, won't the option buying be beneficial? But there is this other saying comments as well, like option buying is not as profitable as option selling. So because I've seen many people say about that option buying always leads to losses and people don't majorly make profits. Since they don't have that much capital to invest for option selling, they're going for option buying. So like how to manage this thing?
See, option buyers also will make money. Option sellers also will make money. Now, option buying is limited risk, but people are losing a lot of trades. Option buyers are generally losing a lot of trades. And in option buying, the risk is limited. Now, when it comes to option selling, the risk is unlimited, but more people are making money in option selling. So both option buying and selling is having their own pros and cons. So what we have to understand is option buyers also will make money, option sellers also will make money. But we have to understand that when you have to apply, okay, when you should be an option buyer and timing your entry is very, very important. Now, let's say, for example, I am saying Nifty is bullish, buy call option. I'm telling you, okay, immediately, let's say you are buying a call option. There are higher chances you might buy at an expensive price. Correct? Let's say I'm telling Nifty is going to go up, buy call option. I'm telling you, and you are buying a call option. Now, there are higher chances you will buy a call option, Nifty will go up. But what if you are buying at an expensive price? You don't know whether that particular option, call option, is expensive or not. You don't know that. So, there are a lot of concepts to understand. Though market is bullish, though I am buying a call option, I should have the basic knowledge of whether I'm buying the call option at a fair price or not. Okay, there is a concept called as fair price. Now, let's say, for example, you are buying an iPhone. The worth of iPhone is 50,000. Let's say, for an example, will you buy that 50,000 worth of iPhone for 1 lakh rupee? No. Nowadays, option buyers are losing money in option buying because they are buying a 50,000 worth of call option at 1 lakh rupee. They are paying 1 lakh rupee and buying a call option. So by the time that call option comes to its original price 50,000, they are in a loss of 50,000 and they are losing money. So there is a concept called as fair price. Okay, if the worth of iPhone is 50,000 rupee, you have to buy at 50,000 rupee only. Okay, so same way, when you are buying options, there is a concept called as fair price. You have to buy at that fair price only. Only then you will not make frequent losses. All right. And when it comes to option selling, again, in option selling, there is a concept called fair price. You have to sell at that fair price, only then you will not face losses. So without knowing this fair prices, people are entering into the trade and they are incurring losses. So as I said earlier, you have to be adaptive. You should do both option. You should do a mixture of option buying and selling. Okay. And I will give you one example. Now, let's say you are running a restaurant. You cannot run a restaurant successfully by providing only one dish. You should need a Indian cuisine. You should need a South Indian cuisine. You should need a North Indian cuisine. right? And you should need some Chinese cuisines. So only if you have a wide variety of recipes available, you can run a restaurant successfully. All right. So only with a single recipe, like only by South, if you are running a restaurant only by South Indian foods, no, then North Indian people will not come and eat, and people who are liking Chinese food, they will not come and eat. So you should have a mixture of everything. Then only then the restaurant business can be run successfully. Same way, in trading, you should do option buying, you should do option selling, you should do day trading, you should do swing trading, you should do everything. Only then collectively you will be profitable in trading.
So a follow-up question for this is, what ways we can find the fair price for the premium? Is there any set of rules or something like that?
There are a lot of strategies. There are a lot of strategies. It cannot be put into a single word, or it cannot be put into a single sentence. So there are a lot of methods to identify the fair price. So those things are covered in advanced courses. Okay, those are covered only in far advanced courses. But as a beginner, I will ask everybody to stick with short-term investing, which is called as momentum investing. And I would advise everybody to focus on swing trading, and then you can think about this advanced concepts.
Yes. So next question is VIX directly interrelated to options premium?
Yes, definitely. Because based on the VIX is nothing but it shows the fear and greed in the market. So if people are greedy, then the VIX will be very low. If people are fearful, if more people are selling, then the VIX will increase and it will show the fear. If more people are buying, then the India VIX will come down and it will show that greed is there. So India VIX reflects the emotions of the Indian market, and it is decided based on the calculations of total number of buy position against the total number of sell positions. Okay, there is some calculations. There are some formulas for India VIX. Based on those contracts, based on the numerical value of the contracts, only India VIX is derived. So that is directly linked with the option prices. It will affect the prices. Yes.
So and another thing is, recently there are speculations on the budget that the tax on FNO would be increased. So is it a measure to curb so many retail investors losing the money, or since many are making money, is that, and how impactful it will be on the market? Will it reduce the number of players in the market?
See, definitely it will not reduce the number of players, because 89 to 90% of the traders are losing money in the Indian markets. Only 10% of the traders who are trading in Indian markets are making money. So 90% are losing money in Indian markets. So since they are losing money, they are not going to pay any tax. So the 90% of the people are going to trade anyways. They will continue to trade anyways, and they will lose money anyways, and they are not going to file any returns. Clear? So it will not reduce the number of players. The problem is only 10% of the people are making money. Out of this 10%, 5% people's profits are going away for paying the taxes, brokerage, STT, GST, etc. And in a net, they are not in profit. So even out of 10%, only 5% is not 5%. People's money is going away for taxes and brokerage itself. So again, they are also not going to worry. They are not going to, because they are not making money. They are not going to pay 30% for the government. So no problem for them. The remaining 5% who are profitable in the market, it's going to be a big burden for them. So if the government want to reduce the number of retail participation, then there should be an increase in margin requirement. See, you can buy an option for 500 rupee, you can buy an option for 1000 rupee, you can buy an option for 2000 rupee. So retail people are entering into the market with less capital, like 5,000, 10,000, 1 lakh, 2 lakh. So let's say the exchange or the regulator increase the margin requirement. Let's say people should start with the capital of 10 lakh rupee only. Let's say the regulator or the exchange says people should start with the capital of 25 lakh rupee. Then most of the retail people will be out of the game, because most of the retail participation is with a smaller amount. So the margin has to be increased. Only then the retail participation will be decreased. And there should be some implementation of any necessary courses. Like people should complete this course, only then you have to trade in markets. A minimum knowledge requirement should be there. What is call option? What is put option? What happens when you buy call? What happens when you sell a call? Okay, so this basic knowledge and basic understanding examination should be there. Only then the retail participants should be allowed to trade. If this happens, then the retail participation will be reduced. How come charging more taxes will reduce the retail participation? Again, so this is just a burden among the profitable traders like us.
Okay. So the next question is, you said the mutual funds do buy the futures option as an hedge. So do they invest? Do they buy also the options market as well?
Yes, they buy in options as well, but it will be limited. Okay. Now let's say if mutual funds are taking a counter position, and let's say the mutual funds are buying options, again it will be a smaller portion only. In the major portion, they will be selling options, and smaller portion they will be selling futures also, and smaller portions they will be buying options also. Again, everything will be there, but it will be in a limited numbers. Majorly, they will be doing option selling only.
The next is, how do I do invest in index options? So is it advisable to continue in that, or should I start in the stock options too with the same amount of capital?
See, first of all, index options itself is sufficient to make some decent money. Okay, if you are not yet profitable, then try to focus on index options alone. Okay, please don't focus on stock options, because why I'm telling this is, there are a lot of retail people, they are selecting stock options, especially illiquid stock options. Okay, or they are selecting stock options which are under FNO ban. Okay, so what happens? There is a risk of losing a huge money easily. So people are buying illiquid stock options. So they are buying at a expensive price. And when they are exiting the trade, they are exiting at a very cheaper price. So because of this illiquid options, they are not aware of it. People never look at market depth, and people never understand about these illiquid stock options. So don't focus on stock options initially. There are a lot of ways to make decent money in index options. So please focus on index options. That is more than enough, more than sufficient. Stock options is not necessary.
So the last question would be, how should one handle their emotions when they are starting off with trading, or once they are practiced as well?
See, controlling emotions, it is a very big subject. Like, you can control your emotions only by repeated live market practices. Okay, you should consider this as a business. Okay, people are trying to outsmart the market. It's not possible. People are not taking this as a business. People are taking this as a game, right? People are taking it as a gambling. That's the reason the government has brought up the FNO under speculative income. So people are considering this as a game, and people are not considering this as a business. So when it comes to emotion control, a lot of things plays an important role. People are not in good mindset, and they are entering into the markets. Okay, people are not having a proper mindset. People are not having a proper trading strategy. They are entering into the market. So the only way to control your emotions is considering this trading as a serious business, and having a lot of experience, real live market experience. Okay, without any proper knowledge, people are bringing in huge capital. People are taking personal loads and bringing in huge capital into the markets without proper knowledge. So these things should be avoided. This is a business, and only through repeated practices you can overcome your emotions. And this is what I can say.
Uh, I would like to
thank you for this session, sir. So
Thank you,
our
Vinit.
questions are got over. Many questions have been asked to you, and many of the answers we got it and got clarified. Thank you for your valuable advices, sir.
Thank you, Vinit.
Yeah, sir. So we would look forward for more such sessions in upcoming days and more to learn from you.
Thank you. Definitely, Vinit. Thank you so much.
Yeah, sir.
Thank you
Thank
so
you, sir.
much, sir. Thank you for
Thank you so
accepting
much,
our
sir.
invitation.
Thank you
And
for
as Vinit said, we are
giving your
expecting a lot
valuable
more
time.
from you.
Thank you. Thank you so much.
Thank you so much.
Thank you, sir.
Thank you.
Thank you, sir.